Hey fellow stock guardians, happy Tuesday, July 6, 2021. I'm Hoda, a stock card CEO, reporting to you after the long weekend from a mixed stock market. I reviewed the bond yields and service sector reports that may have moved the market today, explored two high conviction stocks by the Twitter community, and looked into the US listed Chinese stocks that were down today as a result of regulations and investigation fears. The stock market indices ended the day with a mix of red and green. The story is quite the opposite of last week, with the Dow and the S&P indices closing in the red, while the Nasdaq took its turn, ending the day in the green. One factor dragging the market may be yesterday's report about the bond yields dropping. This could mean investors are wary of the future. Another analysis to consider is the Institution of Supply Management Services report, better known as ISM. This indicator gauges the service sector's growth. May held a record high of 64%, but ISM's June report today shows a slowdown in growth to 60%. There is still a strong upward trend, but this may be a sign that growth is peaking and investors didn't like that possibility. Let me take a moment early on and send my appreciation to all of you as stock guardians. Thank you for watching, reading, and listening to the daily market recap reports every day. Our mission is to make investment research painless for you. If you haven't already subscribed, make sure to hit the like button and subscribe to the show, or create a free account on stockcard.io to get the daily market recap reports in your inbox. During the long weekend, folks, I was scrolling through Twitter and came across a thread by one of my favorite investors, Tom Gardner. Tom is one of the co-founders of The Motley Fool, and he shared 5 of his high conviction stocks. Several hundred investors chimed in. While the responses below his tweet are great, I found his top picks very interesting. 2 of the stocks are not very well-known tickers that I thought you'd be interested to learn about. Paycom, ticker PAYC, is one of his picks. This company is one of the first to bring payroll systems completely online. As you can see on the company's stock card, it operates in a few high-growth markets, such as workforce payment products, that is expected to grow by more than 10% in the next few years. As I scroll further down, I notice Paycom's strong operations. Last fiscal year, revenue growth was 14%, and the company is expected to grow more than 21% this year. It is profitable. It has a strong balance sheet and generates free cash flow. I love it, and I'm going to follow this stock to learn more about it in the next few weeks. The next high conviction stock from the Twitter thread is Docebo, ticker DCBO. Docebo provides digital training platforms and programs to employers. Even if employees go back to physical offices, employee training is one of those activities that can be conducted fully online. Just like Paycom, the company boosts a solid growth potential and strong cash-generating operations. Both these stocks are worth following and adding to your watch list. One thing you may have noticed is that both stocks have 2 green boxes for growth potential and operations, but unknown past performance and valuations. This is quite common among young companies and recent IPOs that have a lot of potential. So let's create a 2 greener watch list for companies similar to Paycom and Docebo. I go to the screener page on a stock card, start a new filter, and choose high growth potential and a strong operations filters. I also make sure that past return and valuations are unclear, just like those 2 stocks. And finally, look for companies with overexcited investors. And voila, I have a list of 37 stocks that could be your watch list for your high conviction, less known companies. I'll leave a link in the show notes for you to get the list of my 2 greener high conviction watch list. For the loser stocks of the day, let's talk about last week's news that the Chinese government is investigating the brand new IPO DIDI Global, ticker DIDI, for data security concerns. DIDI is known as the Uber of China. In the process, the government barred any new customers from downloading the app, and shares unsurprisingly plummeted. This, of course, led to many investors rethinking how safe their money was in the US-listed Chinese stocks. Fearing that the crackdowns would be applied to other companies, the sell-off spread to other Chinese listings. The government cited possible issues with illegal stock trading and data privacy between these companies and other countries. Pop Culture Group, ticker CPOP, is also one of the newer IPOs affected by this panic selling, losing nearly 41% by the end of trading day today. Because the company is focused on building international relations with the US companies, it may be an investigation target. This may give us an opportunity to pick up shares of Chinese stocks if we can tolerate high volatility that hits these stocks every now and then. Type in China in the search bar and get the list of all companies listed in the US that are headquartered in China to start your research. That's it for today. If you haven't already done so, please give StockCard a try. Research as many stocks and ETFs that you want, and consider following a few successful investors by visiting the Stock Picks page on the StockCard platform. Don't forget to sign up for a 14-day free trial with promo code ROLLWITHOURCEO, all lowercase and in one word, to give extra 10% discount. And make sure to like, subscribe, and share these market recap reports with your fellow investors. Come back tomorrow for another episode. I'll see you then.